You're thinking of building a company or already run a company that is not registered, but you want to get registered. I've looked at a lot of solutions, and one of the best ones in the market right now is Doula. I reached out to Arjun, who is actually the founder of Doula.com. I asked him if he'd like to work together on the podcast. He was like, of course. Doula is sort of a platform that helps founders and businesses form and manage US companies, regardless of where they live. If someone is living in India, for example, and wants to start a company and get it registered in the US, he or she can do it by using Doula.com. Doula helps in forming the company. It can be an LLC, C Corp, or you name it. Doula offers a US address and a bank account to users, which can allow you to conduct business transactions that you can receive and send payments no matter where you live in the world from the United States. And other than that, they also provide tax consultation to the users, which is an incredible feature. And Doula simplifies the process of establishing and managing a US company, and especially for founders that are not in the US. And regardless of where they live, you can get your company registered with Doula.com. To check out Doula, go to doula.com/exerton. That is DOOLA.com/EXERTON. Hey Karthik, how are you? Hope you're doing well.
Hey, Avik. Thanks for having me. All good.
Yeah, I've been eyeing this one for a very long time. Recently, I think a month or two ago, I had Sudhir Sethi from Chirate on, and then I'm glad that we got the chance to do this. But before we get into the ton of stuff that we have planned out, let's start with just a basic intro. Who's Karthik? Who are you?
Um, Classic engineer MBA pedigree from the 90s. Decided I want to go abroad for some time. I think that ended up me doing a second MBA in the US and led me into the world of sort of how technology is impacting everything around us, not just the deep tech computer science, hardware stuff, but affecting conventional business the way we didn't anticipate it, say, before the internet. So that was what I landed into in the US, and that's kind of sat on my head for 10 years before I started Blume, and that was the motivation for becoming a venture capitalist. I think the other motivator was reading about venture capital as one of those professions that allows you to sort of almost play for the positive black swans in your life, right? And so it was in one of Talib's chapters, and it reinforced what I thought I wanted to do for the rest of my life. And and that was in the mid 2000s when Black Swan came out. It was written more in response to negative consequences, but the positive consequences around Black Swans are like these remarkable hits that you see in life, which change either a person's life or an industry and things like that. And ventures seem to be like the best manifestation of all of that. And so the obsession to try and start a fund began then, and I've been doing this for 13 years now.
When you came back, what did Venture India look like when you came back and wanted to work it?
I think the beginnings of what you see today in terms of both people, personalities, firms was just falling in place. That was the 2004 to 6 era. And in totality, you have most of the actors are still around. Some are retired, perhaps, or going to retire at some point. But the firms are probably the 8 or 10 names are around from then, and another 5 to 10 have disappeared. But this was because that initial phase was entirely built with West Coast capital and thinking. Right, we essentially were importing the Silicon Valley model as is. The indigenous sort of build out of India. There was some trial and error all the way from the late 90s to 2010 or so, but almost nobody from that pre 2010 era, other than one or two firms like Venture East, etc., from the indigenous set actually exist. Right? Of course, people have morphed. Like Kalari was born out of MEA Indo-US. Chirite was born out of IDG. But people have rotated, but the original avatars have all disappeared. But that's it. That was the set. There were like 15, 20 players in total. Believe it or not, Intel Capital used to be very active. Now they've gone. Um, Qualcomm is still kind of active. Like, there were some of these corporate VCs and there were the Silicon Valley brand names, and there were Indians who were done in Silicon Valley who decided that venture in India as time had come. So they wanted to start firms, and that was Helium and, you know, um, Inventors and NEA Indo-US, which became Kalari. Um, so I think that was the evolution that I was watching in slow motion between 2005 and 10. And it felt like there was just a huge need for somebody to come earlier in the funnel, and that was the birth of Blume as an idea. We're not the only ones thinking that clearly. There were like 10 firms, I think, in that first half of the decade that were born in India. And now that number's grown by dozens, if not almost 100 plus. So there's the whole micro VC movement becoming early stage VC as a whole has probably grown 10 times over in the last 10 years.
It was like what Sudhir said. He told me when he was on. He told me that indigenous capital started flowing from Indian LPs into the funds in about 2013. What do you think
Yeah.
marked that change from the flow of capital from external countries to almost zero capital from Indians versus Indian LPs just trying to become a part of the venture
Yeah. No, so Sudhir was a mentor, supporter, even in our first fund. So, Sudhir and TCM, they actually put a tiny, tiny check in Fund One. So Sudhir is mostly accurate from a dollar perspective and number of people who actually participate in Indian funds. I think it was almost unheard of before 2013. And it's a huge difference by 2018, where thousands of venture LPs were born in India. They used to play a little, but in private equity. Um, and I think they were, but coincidentally, the humble brag we have is we were the first Indian fund in 2010, 11, 12 to basically raise 100% of our money in India. So that's a fallacy to say that nobody did it. We had done it by then, but it was not easy. We knocked on maybe 500 doors to get 75 to open and give us some money, right? So that convincing of people that this is an asset class where it's the only asset class, if you think about it, in financial in the financial world, where you have to upfront disclose that you will actually lose some bets, right? And that it's a part of the game, and that's difficult for people to digest when they give money to a quote unquote a money manager of any kind or an asset manager of any kind. So to imagine saying that about public stocks, right? Imagine saying I'm going to invest in 30, 40 stocks and I'm going to lose money in 10 or 15 or 20 of them, right? You will be thrown out of the room, as were we. We were also thrown out of the room. But basically, that understanding that this is how venture works took a long time because, as much as this headline grabbing around fundraising, etc., this curiosity wasn't around to even learn more about the asset class. And private equity sells itself like public markets. So there's no difference almost in how it's projected. Even private equity doesn't like losing principal on any bet, which is why they write the terms they write. They come into mature companies, they come into profitable companies, and they try to multiply. And they don't play for 10, 20, 30x. They play for 3, 4, 5x in terms of multiplier in value. So investors were only used to that, right? So you try and throw this new asset class out there. Of course, it's going to take time. And until you see success stories, and then you have a little bit of FOMO saying, hey, I have no allocation to this whole idea of technology. And then you're saying, look at the virtues of UPI and Geo and all of these elements. And none of these were visible back then because they didn't exist back then, right? And so then you realize that, Mukesh Bhai is making so much money off the consumer internet by launching Geo or building on top of that. And as a Reliance shareholder, they're getting the benefit of that tech, but they have no direct exposure to it. So, a smart investor will always say that I have to take a certain percentage of capital and allocate it towards that, to that exposure. Because if India is going to grow or at a certain GDP rate and is going to have a bulk of that growth come on the back of technology enabling it, a lot of companies are going to do well in that space. How do I get access to that? It's very difficult to go see what's happening in early stage or buy into private companies. And so you start giving money slowly to fund managers. So I think the proportion of capital in the number of people who raised from domestic has gone up. The amount of money that's come in has gone up. maybe tenfold. The proportion of Indian money in our funds has gone up. All of that has gone up. But in all humility, all of that put together is probably still less than 10% of all venture capital that comes into India in absolute terms every year. Because the absolute is still the person taking the $100 million single check risk, the $50 million Series C risk, right? So that kind of capital doesn't exist in India. Nobody's making those bets. For the handful that are like these very large now HNI family offices. So it's a function of seeing success. So a Premji Invest sees success in Lenskart. They will come and take 3 more bets like Lenskart, so on and so forth. If a Ranjan Pai has got liquidity from his healthcare business and he's now looking to diversify and he makes half a dozen bets in tech, worth a few $100 million and 2-3 of them work, then he's going to make 10 more. That's why he's in the headlines today or 2 months back and 4 months back. He's become very active. So it takes those kind of pioneers and then everybody else follows. That's always the case. That's how financial markets evolve in general.
Does that make a difference for you as a fund, raising from foreign investors versus raising from Indian LPs?
I think Indian LPs, the disadvantage that we have with them is a lot of them, cost of capital is higher, return expectations are higher. They are on the ground here, so they get access to the exposure that they want in a direct fashion as well. So if I go to an ultra high net worth individual who has a big family office, 1,000 crores, they're shown a lot of interesting deals directly. And because they're on the ground here and a 2-hour flight distance away from any good deal, they can actually go do the diligence, they can monitor it, they can do the work themselves. So their motivation to give me money as a fund manager is very low. Other than access, other than relationships, relative to an overseas institutional investor whose job it is only to allocate. They don't have time and bandwidth to come. The pools of capital are also very large. Some of the US endowments and sovereigns run from the low billions to 10 billions and the 10 billions to the 100 billions. So when you have that kind of capital, you can't come and take early stage risk yourself, right? So they have to allocate to us. So, crudely put, I'd rather go and pitch to more people whose job it is to allocate money to me rather than go and convince others to part with their dear money, which they think they can manage better, right? So in the same asset class. So while 40% of my last fund came from India, I wouldn't be surprised if that percentage falls in the next fund. As if I can convince more overseas institutions to back me, just the quantum of money that each one of them can give makes it sadly more interesting to go and just pitch them, even if it means a lot more flights and jet lag and whatnot.
And what does the LP base in India really look like? Are there endowments in India too, or do endowments only invest from the US or the foreign countries?
No, endowments are like broadly not-for-profit or charitable or long-term pools of money that are set aside for creating income streams on an annual basis, but create wealth over decades, right? That's a new phenomena in the Indian context, whereas in the US context has been happening for 30, 40 years. And also the US you have to have a lot of wealth created first for an endowment to start, right? Wealth creation and parking into an endowment is a 20-year phenomenon in India. If you had that kind of money, you would redeploy it, right? Some companies build conglomerates. Some companies built, new businesses, right? They got into new businesses whenever they had that cash richness. There was not a culture of, charitable endowments and foundations and investing through such this thing. Investing as a standalone business was never thought of as something. It was a luxury that nobody really had. You have to be spitting out cash for it to happen. And that is, as I said, a relatively new phenomenon in India. So we don't have too many of those. I mean, recent press articles say that the Premji group has reached close to 10 billion, 8 to 10 billion. That's one of the largest in the country. Then other family offices are not set up in the same way, though they allocate capital to managers like us. And we don't have other than the Indian sovereign, which operates through NIF and then through SIDBI for venture, we don't have too much sort of central government money. We do have like banks and insurance companies and other financial pots, but they're not savvy. They haven't figured out how to allocate to venture yet. So they've played some private equity risk, very little venture risk. And they're really truly paranoid about the idea of losing capital on a bet, which is what venture is. And so there is a lot of money in pension funds, etc., in India, but all of that hasn't come into the system. Pension funds and insurance money is very slow in coming into the system. And I think if India creates a lot more wealth over the next decade, this will automatically start happening more. And when people see success is when they, as I said, they double down. So it takes a 10-year cycle just to show success in venture, right? So now you're beginning to see a lot more stories around family offices doing well on tech and increasing their investment and exposure to it. The other day, I think there was one on the Marico family, $300 million. A lot of that money made on Nika. So, those success stories breed more commitment to continue investing in the space. And then talent pools begin to emerge. And you need talent also. You just can't have a lot of funds and say, let's go do it. Where is the talent to manage that capital and manage that risk? At an LP level as well. So all of it is happening. I don't think these things take 5 years, 10 years at a time to evolve.
And how are LPs looking out to make the money? Is it the full, complete fund cycle, or are they looking for secondaries and buyouts too?
I think everybody likes to see the liquidity cycle play out more sustainably and more predictably. I don't think nobody thinks of life as I want secondaries, I want intermediate outcomes. They want 20 plus, if not 25+% IRR compounded. That's a given. Otherwise, they won't play venture. If they've committed in their head for an 8-10 year journey, I don't think anyone is making stupid demands in the third or fourth or fifth year. We're still drawing down money till the fifth year. Just FYI, right? We don't take all the money up front, right? We take it over 5 years. So in the fifth year, I'm still asking for the last tranche of the money. So that's the question of expecting money back. So when they reach the 8th, 9th year, and if they see zero money coming in, they get a little nervous. So the general expectation is around the 8th year, you're hopefully giving the capital back by way of early exits. How you generate those exits, they don't care. You could have done M&A, you could have done IPO, you could have done secondaries.
Like family offices versus HNWI, high net worth individuals, do they look at it differently as to how much they want to allocate based upon previous performance of the funds?
I think the level of sophistication is a little different, but I don't think they look at it very dramatically differently. And the level of allocation that they can make is a function of how much total wealth they're operating out of, how much liquid wealth, and how much they want to allocate to these assets. So I don't think tech and venture in most portfolios will have more than 4 to 8% allocation in that sense, right? So unless the person has made all their money through technology, then they understand it, they think of it as a extension of their core business, and they probably have 25 or 30 or 40% allocation. Let's say like the Bansals of Flipkart, etc. Right? But otherwise, if you look at an average UHNI or a family office, it's somewhere between 4 and 8% today. 10 years, 13 years ago, it used to be between 0 and 4% for most people.
How long do you think before that their allocation is similar to or on par with people or the HNWs in the US or in any country?
It's getting there. It's not, you'll be surprised, it's not much higher in most parts of the world. It's middle to high single digits, that's it. Nobody should allocate more than that also. It's a high risk asset class. It's a long-term illiquid asset class. For wealth management, it's not a good idea to go all in on venture and tech. There's enough pools of capital. More pools have to participate. See, there's only finite tech risk the world can absorb at a point in time. Who will fund it after that, and after that, and after that? And is the customer going to pay for all of this so that you can actually become? So if the world GDP is growing at a certain rate, you can only, unless you're doing something radically to shift it to a new technology, you're eating somebody else's lunch, like, streaming took away DVD and VHS lunch. That you can do, but otherwise the capacity to spend on something is always finite, right? So it's not like you can suddenly throw more money at the problem and it'll take off. It's like going and mining more coal at this point. There's no point, right? It's on the decline. There is only finite use of it, etc.
Do VCs in India have the same risk appetite as the ones in the US?
Huh. No, I don't think so, because I think again it's a function of has that risk taking paid off? You simply can't tell somebody, I'll inject you with the serum, go take more risk, right? Eventually, the mind says, on the basis of that risk, did I make a boatload of money? And if you haven't made that money, I'm not going to be able to tune my risk upward. It's absurd, right? In the US, there'll be, if you look at the 100 VCs in the Midas list that the US publishes, a lot of them put some track records there. And there you'll see the number of unicorns, number of IPOs, number of $10+ billion companies, right? Which means at least about 100 of them have all of that in their track record. In India, there'll be like 10 guys who have that track record. How can the risk appetite be the same? So we can only grow into it by delivering those outcomes. I don't think we're anywhere close to delivering them. Take another 5-7 years. So people who have played in Zomato or Freshworks or Nike or Policy Bazaar, they obviously have more risk than I would have, more risk appetite than I would have. I haven't seen those outcomes yet. I have a handful of unicorns, but until I see the money or the moolah from there, the cycle is not complete. I only pick public companies for a reason in my example, right?
Yep.
It's important to complete the cycle. Then when you see that the money is at the bank, then you say, damn, I've made on a $5, $10, $15 million bet, I made a few $100 million. So I know it's possible. At least that's where I come from philosophically. Some kid comes and tells me I know how to make money. I don't believe it necessarily because they've never done it before, right? So you're winging it till you are faking it till you make it in venture, right? And then once you make it, your risk appetite calibrates itself upward. So it's not like I'm waiting for that perfect moment to take more risk. Today we write $5 million checks. 3 years back, we used to write $2 million checks. Before that, 3 years back, we used to write $1 million checks. And 3 years before that, we used to write 250K checks. What changed? It's the same person. What changed is the outcomes that we generated from each one of those checks in the cycles have started showing us bigger and bigger outcomes in every consecutive cycle, right? Much faster, even though 80% of them are still on paper. Forget about the valuations. I'm looking at the underlying revenue math, for example. So what used to be a fund one company just crossing 100 crores today, 10 years in, a fund three company has already hit 500 crores. So when you see that, when you see that scaling possibility, it could be a variety of factors. It could be market, it could be the capital you provided, it could be the quality of entrepreneurs, it could be everybody's collective risk appetite. I'm not getting into the reasons, but when you see that is when your risk appetite grows. Long answer for that question, but it's an important calibration. This is how calibration of an entire ecosystem goes up. It should go up in that thematic fashion. Sometimes greed gets ahead of you and you say, well, if I throw $200 million at the problem, I'll create more unicorns faster. And then you realize that was a mirage. And then, 5 out of 10 of those collapse, then you recalibrate downward, which is what's happening right now in the market. So eventually, I'm a huge believer the market is the eventual god in capitalism. And you have to keep listening to the market and recalibrate as per where the market is or where it's going, as opposed to trying to be, too ahead of it, right? You get rewarded for being marginally ahead of it, but not too ahead of it.
How do founders recalibrate with the market? I mean, if you are giving them half the money and telling them to 2x the growth, how is that happening?
How is it happening? There is no. That's the mark of an entrepreneur. No, entrepreneur's job is not to keep losing money, right? So eventually, all that means is that you either figure out that you have a product that can actually monetize or not, and if it can, you basically whittle this down to a sort of a growth rate that might not look very sexy at 40, 50, 60%. It might grow 10%, 20%, but you manage to do it with half the team, basically. That's what half the cost usually means, right? It's half the team or / half the marketing. So the team, if you're going to cut half the team, you have to run an incredibly tight shop and not have, stupid labor costs, which happens in bull markets, right? And if you're doing it with half the marketing cost, that means your product has to be twice as good, right? So essentially, it's a true test of whether the product was actually as good as you thought it was for it to sell itself. And finally, if you didn't get the margin math right, there will be distress, there will be collapses, and there are going to be. You've seen a few. Some of them have not been written about very widely. Some have been, but when the final, you know, sort of line of that story of the downturn is written, I'm sure we would have had 20-30% casualties and calamities, right? Because they can't match these contradictions. Like you asked the right question. If I gave you half the money, would you be able to manage and get profitable? Even after selling that story, nobody wants to believe them anymore because they've never shown
Doesn't
it
that,
before.
yeah,
Yeah, they've never shown it before, and they today. Why would I believe you? I gave you money thinking you were going to turn profitable or you're going to run it well. You ran out of that money. How? Why would I give you more money believing that you're going to do better? So there are some companies facing the brunt of that emotion today because they've run through too much money in the past.
doesn't that harm the innovation sort of that happens in the country? If I take deep tech, for example, deep tech companies take a lot of money to build before they are sort of able to show any money to the investors. Doesn't this put a restraint upon that?
No, not really. I think, look, if you all early stage risk capital vanishes, then you're right. I think there's enough early stage risk capital. I think the mark of an entrepreneur is like you got to be, that's what I said, you got to look at the market, read it, and calibrate your growth. Is survival and ability to continue building more important, or is it all about like, saying that it's now or never? It's possible. There might be innovation where it's all time to global markets, for example. And if you're going to take 6 years and the German company is going to take 4, and the American company is going to take 2, then why even bother building it? Because India has not been able to give you capital that to be able to compete with the global markets, and they're going to take all the market share. But that's a vanity argument. It's very, very rare that you can't build a self-sustaining small business. Sometimes it might not be venture fundable, or it might not pay enough for you to pursue it. So, for example, if you have to sit in a lab with $1 million and work with 3 people tirelessly for 5 years, the math doesn't work. The opportunity cost is too high. You can't retain 5, 6, 7 people of that nature. Everybody might walk out of the door. So that's when you kill the company. But I'm just saying, until you try, how do you know the answer? So if you want all answers up front and you want somebody to walk in through the door and give you a check and say, hey, life's going to be hunky-dory for 5, 7 years, there wouldn't be anything called entrepreneurship, no? Everybody will be a job seeker, right? So it's half of entrepreneurship is your ability to sell the vision to every stakeholder. So if you're doing a good job of that, you'll raise money in a market that's capable of taking the risk. You're absolutely right. If you're a deep tech founder, forget about today. Even at the peak of the boom, it was very challenging to raise money. The market for deep tech capital is not there in plenty in this country. Then here and there is sprinkling, and even if Blume took deep tech bets, we won't take more than 3 a year, 2 a year. So if we have made 3 a year, there might be 300 great other ones, but I'm not going to take more bets. I want to be diversified. You know why I do that? Because there's nobody after me who might cut those checks. So I don't want to be in the same boat as the entrepreneur every time, struggling to get my companies to the next stage. So I'm okay living with some of that risk, but not entire portfolio of that risk. Some funds have taken that challenge, right? If you look at an Idea Spring or a Special Invest, they only do deep tech. So they're willing to take that risk, right? I'm not. At a 250 plus million fund, I think it's too much capital to risk more than 20-25% on deep tech. So that's how I calibrate risk. Now, that's not prescriptive. Like, somebody else who has more guts than me will run a $100 million deep tech only fund. And that's how the market moves. That's why it's called a market, right? So if there is opportunity, it eventually balances itself. In the long term, the market is the only thing that wins, right?
I think this is being clear. I think we'll take a hard stop there. But this is incredible. One question which I'd like to end with. Like, I've been into startups, VCs, and all these things like we're talking about since I was like 11. What do you think is one fact that will blow 11-year-old me mind? Yep.
Hmm. One fact. Hmm. I think if I had to, I mean, obviously, I'm speaking with the benefit of hindsight from where I'm sitting at today. Um, I think it would be just to explain, however imperfect the science is, uh, the the fact that Earth has actually gone through these, 6 mass extinctions, and as much as it might feel like we are a blip on the timeline, how we've created circumstances to artificially accelerate, you know, uh, the way climate and the weather behaves, and theoretically the fact that we are somehow alone in the world. We are a bizarrely, single planet with this much life evolution in over a few million years. And when you combine that, the child should be able to imagine what the possibilities are with these boundary conditions, basically. And hopefully that builds a more sustainable kind of thinking in an 11-year-old around how they want to protect this one planet that we know as a species.
Yeah. I mean, that blows 15-year-old me mind, but uh, I think this is incredible. Thank you so much for taking the time out for this. I think that's it from my side. Anything you'd like to say?
No, thanks, Advik, for the opportunity. Keep being super inquisitive, curious, and keep asking all these questions. It's a great way to learn. And hopefully, I don't know who your listeners are, but hopefully this is useful for them, and happy to sort of share it once it's out with everybody that I usually engage with as well, so that they just know what's cooking in the mind of a teenager today, yeah, and what kind of questions they have. So I would
Yeah.
love for everyone in the firm to listen and learn as well. Thanks.